So what I'm doing, I'm recording it. So those students are not there, they can just go through, because whatever I'm doing today, the last class, and then we have presentations the next. So just open the file which I have, shared today in the morning, Excel sheet. Just check whether we have done this question in the class. I think in one class I have done, in another class I haven't done. Okay. So we'll be doing one question, which is a practical one, and the question paper will be, there'll be no Excel sheets, nothing. So you have to do on a, through pen and answer sheets on your sheets, and there will be, I believe you have to do 4 questions. Each question carries 12.5 marks. So it will be part of theory and practical mix. Okay. So 2 practical questions, okay, which you can attempt, and 3 theory you have to attempt. Okay, fine. Out of the 6, out of the 2 question, 2 theory, 2 practical. Okay, so 4 questions, and there will be 5 questions. So 1 you can skip. Is that okay? Or you can do 3 theory and 1 practical if you wish to. Just I'm just going to tell you everything. You can ask if you have not answered. So there will be 5 questions in your paper, and maximum practical questions you can attempt is 2. Okay, fine, and 2 theory questions, and maximum 3 theory and 1 practical. Okay, so you have to choose any 4 questions out of the 5. Is that clear? No, your part was we have to calculate IRR. No IRR calculation, because it will be all manual, so you don't have to calculate. Okay. So, but remember, we have done a question on, a water park question where you have calculated the cost of equity and capital. Okay. While you have to lever and unlever beta. So do that thoroughly in your class, in your exam. Okay. So let's begin. So open this Excel sheet. Have you opened? So this is a metro rail PPP using hybrid annuity. Okay. So metro rail PPP using hybrid annuity, availability payment structure. Very similar to HAM logic, no ridership risk for the private party. So this question is based on this on this principles. So availability payment structure means it is written on this thing, which I have not mentioned in your this thing. I think I have shared the latest one. So an availability payment is a regular payment made by government to the private partner only if the facility is available and performing according to agreed standards. So government is going to pay a fixed amount every month or every per annum. Okay, and it will depend upon if the facility is working, then only they'll pay. Okay, like suppose there is a project which is functioning, on that basis they're going to pay. If it is not functioning and not workable, then the payment will stop. So metro rail project PPP hybrid. So all figures are in crores. Background: a private concessionaire SPV is developing 25-kilometer elevated metro corridor under PPP hybrid annuity availability payment model. This question I haven't done in the class. पहले करा नहीं ना? Okay. So construction period is 4 years. Operation period is 20 years. Okay. And now this is a long question, so it will not be a practical question. Okay. But some in exam a question will come. You have to theory question, and you have to just this will help you to give you your theory question. Total concession is 24 years. So operation period is 20 years, 4-year construction. So total period is 24 years. And then it starts, the year 5 is when the commercial operations start. Government pays the concessionaire an availability annuity subject to performance during operation. So government is going to pay annuity. Okay, fine. So availability annuity means only when the site is working and delivering results. Fare box revenue is retained by metro authority. So no ticketing, nothing. So all the ridership money which is collected by the metro rail will be pocketed by the government, and private SP has no ridership risk. Okay, so he'll get a fixed income. Okay, so he's not concerned with how much the government is making on account of the ticketing what they are doing. So given information, a project cost and funding. The total project cost is 10,000 crores. Government construction support during construction, 40% of the project cost paid evenly over the construction period. So that means out of that 4,000 crores will be spent by government, balance to be funded by SPV, 60%, 6,000 crores will be spent by the SPV. Debt equity ratio on SPV funded portion is 70-30. Now here 70% is debt and 30% is equity. Now this is because the government is giving a fixed annuity, so the SPV can take the maximum advantage of debt. Okay, so they'll go for 70-30 their own contribution. Interest rate on debt will be 9% per annum. Loan period 15 years from the commercial operations. Repayment sculpted. Okay, a minimum required DSCR, debt service cover ratio 1.3. Okay, so availability annuity paid will be base year. Annuity is from the year 5, 1150 crores per year, and annual escalation of 4% per annum. So that means 1150 will be paid by the government, and every year it will go up by 4%. So performance reduction, assume 0 because the site is working, so there will be no deduction. Operating cost assumption, O&M cost year 5, 250 crores. O&M escalation 5%. So operation and maintenance cost is 250 crores, and operation and maintenance escalation is going to be 5% per annum. Major maintenance reserve 120 crores. Okay, so the company is going to make a major maintenance reserve of 120 crores. Okay, now remember here the word is used, reserve. Okay, so if it is reserve, then they can't claim depreciation on that. If the word reserve is not there, then company can claim tax benefit, because that the company is going to spend, okay, in each year. So here it is mentioned as reserve. Okay, so remember this fine difference, that if in the question it is mentioned there is a maintenance reserve, then don't include it for calculating the tax benefit. But if it is only operation major maintenance, okay, without adding the word reserve, that means it's an expense every year the company is going to do, and they will get the tax benefit. But in this question it is within reserve. Okay, corporate tax 25%. Depreciation ignored, cash flow calculation, so depreciation has to be ignored. Working capital ignored. Additional revenue, so there will be some additional revenue, non-fare revenue, which will be station retail plus advertising revenue from the year 5, 80 crores. So company is going to get 80 crores by way of advertising revenue. So that means they will get space where they can allow others to advertise and earn money from there. So they are going to earn 80 crores. So the growth in non-fare revenue is going to be 6% every year. So now the questions. Okay, calculate the government construction support amount, calculate SPV funded amount, calculate the debt and equity for SPV. Then year 5, calculate the total revenue to SPV, that is availability revenue plus non-fare revenue, O&M cost, EBITDA, cash taxes paid, CFATs after major maintenance. Q3, 15-year CFATs forecast from the year 5 to 19. Prepare a CFAT forecast for the year 5 to 19. Low life. In your question, there is practical question, so you have to just calculate for 1 year. Okay. In your exam, which will be just without an Excel sheet, so you have to calculate the CFAT for the year 1 or something like that. Okay. So it will not be a full projections. Debt service capacity using minimum DSCR of 1.3. Compute maximum allowable annual debt service. Then the repayment schedule, assuming debt service each year is sculpted to DSCR 1.3, build 15-year debt schedule. Okay, opening debt, interest, debt service, principal, closing debt. Then the question is bankability conclusion. Comment whether the project is bankable under the given structure based on DSCR compliance, cash flow stability, conceptual risk. Explain 2-3 lines why this hybrid availability payment structure reduces finance risk compared to fare box revenue ridership risk model. So a theory question will be there in exam, so just focus on the theory part, which will be part of your question paper. So optional a ridership is expected. If the ridership is unexpectedly low, what is the direct impact on metro authority, private concessionaire, lenders? So here since the company is going to get a fixed this thing, so they are not bothered about the ridership. So only the metro authority will suffer if there is a low. Otherwise, the private concessionaire is going to get a fixed revenue. Lenders are also not affected because lenders are not bothered about whether how much people are using the metro or not. Okay. So we go to the answer. So government construction 10,000. Okay. 40%. So 4,000 is the government amount what they are going to. SPV funded is about 60%, which is 6,000. So debt will be 4,200 because 70% is going to be debt out of 6,000 crores. Then if you calculate, the cash flows, so the SPV is going to get 1150 and non-fare revenue 80 crores. So altogether total revenue will be 1230 crores. Okay, so that means they are going to get 1150 crores as the annuity fee and 80 crores as non-fare revenue. So then you have the operation and maintenance 250 crores. So EBITDA is going to be 980. So then the tax will be calculated on 980. So the major reserve, O&M reserve, we are not included for calculating the tax here. Okay. So now we come to the major maintenance reserves. So this is just a reserve. Okay. So company is making a reserve. So company is not spending. So whenever you make a provision reserve, then you are not entitled for any income tax benefit unless you spend that amount. Okay, the logic is there. Okay, like you might have studied in your graduation, or like when your company makes a bad debt provision. So bad debt provisions are not included as an expense. It's in a provision. Okay, only when the actual bad debt occurs, then you show that as an expense. So reserve is not part of your computation of tax purposes. Okay, same logic here. So CFAT is going to be 615 crores. Okay, now annuity escalates at 4%. Okay, non-fare revenue grows by 6%. Then O&M escalates by 5%. Okay, so major maintenance is 120, tax is 25%. So then debt service coverage ratio, DSCR is 1.3. So opening debt will be 4,200 crores. So company has taken a debt of 4,200 crores, 70% of 6,000. Then 9% is going to be the interest. Then the target DSR is 1.3. So now we can calculate the revenues. Okay. So loan year 1, first year of loan, which is the operational year 5. Okay. 1150 is annuity, 80 crores non-fare revenue. So total revenue 1230. Okay. So which is coming from the formulas here. Okay, fine. If you just so 1150 all linked to this thing, which is coming from here. Okay. So total revenue is this: O&M 250, EBITDA 980, cash taxes 245 crores, which is basically 25% of 980. So 980 multiplied by 25%. So major maintenance, a separate line item. CFAD is 615. So which is 980 minus 245 minus 120. Okay. So this is the CFAD. So this way we can calculate CFAD till the year 15. Okay. Fine. So 5 to 19 years. Then opening debt is 4,200 crores. Interest is 378, which is 4,200 multiplied by 9%. Okay, fine. So debt service is 473.08. How we have calculated? Like taking DSCR listing. Okay. So if we take CFAT as 615 and divide by 1.3, so we get the debt service, total debt service, which is 473. So we'll plug in here 473. Okay. So interest is this thing, debt service is this thing. So principal will be the balancing figure. Okay. So in the closing debt will be opening debt minus the principal figure. It's okay. So this will keep doing it and keep the DSCR as 1.3. Okay, as per the term, so we are maintaining. So since the CFATs are growing, so we'll find somewhere in the year 13, the loan is getting fully paid. Though the loan period was 15 years, but since the company is earning a good amount of money from the government, so we will find that the opening debt in the 13th year, okay, loan year will be 29.79. Okay, so interest will be 2.68, 9%. So balance will be debt service. So debt service, sorry, balance will be the 29. So debt service will be. So this has been calculated number. Okay, fine. So in this year, we find that DSCR is jumping to 32.18. It's fine because company has maintained 1.3. Only in the last year, the company is earning because the company is making profit. So this is the total loan schedule as well as the CFAT. So key interpretation, with debt fixed as 4,000 crores and sculpting DSCR 1.3, the loan is fully paid in operational year 17, loan year 13. Okay, instead of 15 years, we are paying off in 13 years. This happens because the availability annuity plus growing non-fare revenue producing strong CFATs, cash flows. In real lending, banks can typically either upsize the debt if they want to maintain 15 years, or back and smooth the debt service so that the loan is paid in 15 years. So we can even do that. Okay. So bankability, CFAT is stable. Okay. And there is no ridership risk. Available payments are coming from the government. So DSR is met in all the repayment years. So debt is fully repaid well before the tenor. So a strong credit. So that means it is bankable project. Is that okay? Have you followed? Okay. So open this file called leverage. A file leverage key. Just open that. Is it there in your Excel sheets? In your just look for a file called leverage. So open this file. So open this file. Have you opened? Just look for the file if it is there. So this should be the file in your Excel. Okay, fine. I have shared this Excel file somewhere in your this thing. Have you got this file? Yes. Okay. So now it's a simple example to explain the leverage. Okay. So sale is, now there is a company whose total, they're selling 1 lakh units. Okay. And the rate of the product is 2 rupees. So that means the company is making 2 lakh rupees revenue. Okay. The variable cost is 70 paisa. So that means the total variable cost will be 70,000. So we know the contribution is sale minus variable cost. Okay. Then the fixed cost we have assumed as 1 lakh. And the EBIT will be 1 lakh 30 minus 1 lakh. So EBIT is 30,000. Okay. Then interest. So let's go to the, before we go to the interest part, if you look at the variable cost is 41% and fixed cost is 59%. It's linked to the formula. So you can just look at the formula also. So which is basically the fixed cost divided by the total cost. Okay. So fixed cost is 59% and variable cost is 41%. So company is having a higher fixed cost element in its structure. So it will have an operating leverage benefit. Okay. So now we come to interest. So the capital structure is like this. The company's equity is 2000 shares of 10 each. 20,000 is equity. And the debt is, company has taken a debt of 50,000 at 11.25. So total capital is 70,000. Okay. Now, if you calculate the interest, which will be 11.25% of 50,000. Okay. So the EBIT will be 30 minus 5625. Okay. And the tax is 73, which is 30% is assuming 30% is tax rate. So this is the tax. PAT will be 70,000. Okay. Now EPS will be 8.5. How we have calculated? We have taken the profit divided by the total number of shares. Is that okay? Now if the earning per share is 8.5 and if the P ratio is 10, suppose the company trades at a multiple of 10, so what will be the share price in the market? 85 bucks in this case. Okay, so company is like this. So company is making a profit, earning per share of 8.5 and the share price is currently in the market at 85. It is trading 10 times a multiple of 10. Okay, P ratio. Now if we just unhide the sheets. So unhide the sheets. Fine. Okay. Suppose the company's sales goes up by 10%. So it has become 1,10,000. So what will happen to the sale? It will go up to 2,20,000. The variable cost will also go up to 77,000 because the units are now 1,10,000. So the contribution is 1,43,000. So sale and contribution has jumped by 10%. Okay. Now what happens to the EBIT? EBIT has gone up from 30 to 43,000. Okay, because the fixed cost has gone up. So that means the EBIT has jumped by 43%, which means a 1% increase in sale will lead to 4.3% increase in your operating profit of the company because of the operating leverage. Okay. Similarly, the interest is also not going up. So the EBT is going up by 53%. Okay. Fine. So a 1% increase in the revenue has led to 5.3% increase in the overall profitability of the company. So the combined leverage effect, the financial and the operating result, operating leverage has resulted in increase of the profit jumping by 53%. Okay. So what will happen? The tax will be this much. So PAT, so earning per share goes up to 13.1. Assuming the company's P ratio remains the same, what happens to the share price? Share price jumps up to 130. With a 10% increase in sales, the company is able to generate a 53% increase in earning per share. Okay, and the share price also goes up. This thing. Okay. Now, what happened was during the COVID time, lockdown time, most of the companies they were, not producing and selling goods, but they had all the cost in place. So the moment the lockdown was lifted, so all the companies which were having a high operating leverage or high financial leverage, their share price jumped. They doubled in 1 year. The companies which were having less operating leverage and financial leverage, their share price didn't jump so much. Okay, they jumped by 20 to 30%. But the companies which had a high operating leverage, because they had everything in place, only the production has gone down. The moment their production and sale had gone up, so they were able to multiply their profits. And before we were coming to the close of the COVID and the lockdown was supposed to be lifted. So there's a recommendation to buy all the shares which has a high operating leverage because they will give the highest return. So you encash in the opportunity wherever you feel that the operating leverage is going to be a major play for those companies which were running at a lower capacity, but the capacity is going to be fully used and they're going to have a higher bottom line increase in their profitability. Okay. So now if you just look at here, now this leverage has it can magnify the profits, or in good times it can even magnify the losses in bad times. So just before that, So here if you just say 1,01,000 to understand the concept, so a 1% increase can lead to a 5% increase in your profitability. Okay, this was a trick. Now if suppose the units are 90,000, suppose there is a loss. Instead of, there's a 10% decrease in the this thing. So you'll find that the sales have gone down by 10%, but the overall impact has gone down to by 53%. The bottom line has shrunk by 14. The EP has gone to 4. So in this case, the share price will come to 40 rupees, multiplied by 10. Is that okay? So if you look at this, the share price will go down to 39.85. Is that clear? Have you followed? Is it clear to everyone? Okay. So the leverage plays a very important part in our company's balance sheets. So, so then, I was just checking. So this file I haven't shared, but I'll share. Okay. So how do we, the corporate earnings in India, particularly, okay, how they can be, analyzed, and how can you forecast the corporate earnings? Similarly, you can forecast the earning of every company based on this mathematical equation which I'm going to share. Okay. Depending upon the economy, how the economy is going to do, and you can just project, what will be our revenue will be earned by all the companies in India. Okay. So this is a mathematical equation. Okay. And then we will find that there is a check also. We can just check whether actually it has happened or not. So what we'll do, we'll study the last 10 years data and see how this equation has helped us to understand the increase in profitability of the companies and how through this equation and how it matched with the actual results shared by the companies. So what I've taken is I've taken Nifty 500 companies. Okay. Now there are about 5,000 companies which are listed in the stock exchange, and Nifty 500 almost constitute 90% of our revenue and sales, more than 95%. So the 500 top companies, they make the maximum amount of revenue and sales. So instead of taking all the 5,000 companies, we have taken only 500 companies to understand the concept. So Indian corporate earnings, PAT to GDP ratio. So there is a very important concept called the PAT to GDP ratio. Complete mathematical framework. Historical analysis from FY 16 to 26 and forward projections for 27 and 28. So we'll understand how this concept will help us to project the earnings of the corporate world and how we can do the projections of the next 2 years, which are yet not, we have not seen them. Okay. So the PAT GDP framework. So the PAT GDP framework is the most powerful tool for understanding and projecting India's corporate earnings. Okay. So once you understand this, you can even, forecast the earning of any company in India. Okay. This I have done. Okay. I'll just show you. I've got it for Reliance as well as for anything I projected. I'll just share the files which you can just go through. But this I'm going to explain. So the PAT to GDP ratio. Now the GDP is the total income of the India. So PAT is sub part of the GDP. So if we take a ratio, PAT upon GDP, so that means Nifty 500 aggregate PAT divided by the nominal GDP. Here what we take? We take the nominal GDP, not the real GDP. Okay, fine. So we take the nominal GDP into 100. So that will be the PAT to GDP ratio. So we will be computing that. Then Nifty PAT is equal to nominal GDP into PAT divided by GDP ratio. Okay, these are the formulas which I am going to explain. Then the PAT growth. So we have to understand the PAT growth concept. Okay, so so there is a formula here. PAT growth is 1 plus nominal GDP growth into 1 plus PAT GDP growth change minus 1. So how it is like this? This means that the profit can grow faster or slower than the nominal GDP depending solely on whether the PAT GDP ratio is expanding or contracting. When the nominal GDP grows at 10%, if suppose, India currently the nominal GDP is growing at around 8.1%. In next 2 years, we expect it to grow at 10%. I'll just share that. Okay. So this means the profits can grow faster or slower. So the GDP is growing by 10%. Okay, and the PAT GDP expands by 3.7%. Okay, so we take 1.1 into 1.0, so which means that the that means the profitability will grow by 14%. If the GDP goes by 10%, the profits of the all 500 companies will go up by 14%. Because I told you there is a leverage impact. The major impact is coming from leverage. If the top line grows by 10%, it's expected that the profitability will grow by 14% in this example. Okay. Now it will all depend on various scenarios. So here I've said that the PAT is growing by 3.7%. Okay. So let's understand that. Now, so why the PAT GDP ratio moves? Key drivers. First is operating leverage. Ratio rises. Fixed costs spread over the higher revenue. EBITDA margins expand faster than the revenue. So there is always the bottom line goes up more compared to the top line because of the operating effect. We have seen in the example. Then financial leverage. Debt stays flat. Suppose you're not taking more loan, as the falls as the profit rise. Sorry, debt stays flat or falls as the profit rise. Interest burden shrinks. PBT grows faster than EBIT. Okay, fine. So now there are cyclical factors. So companies which are cyclical in nature, okay, they generally have, like, BFSI, infra, real estate, have higher PAT margins than the overall economic average. So these companies will show a higher profitability compared to the nominal growth of the GDP. Okay. Then defensive sector drag. That means all the companies which are in IT or FMCGs, they have low margins. So if they will drag the profit down. Fine. So they are not going to have effect of the profitability going up. One-time changes. Like example, we have the labor code coming up in this year, okay, which has dragged the profitability down. Then the tax rate changes. Now we have moved into a new regime. So most of the companies are moving into new regime. The tax rates are going down. So over the last few years, we found the profitability is jumping for those companies from say 30% to 25% or 22%, whatever. So so a lower corporate tax 25 permanently raised the ratio from this thing. So now let's understand some data. So we have taken from financial year 16, the nominal GDP was 135.80 crores. Okay, fine. So this is the published data. Fine. So we got the data from the published data. So it was 135. Nifty PAT 500 PAT. That means how the profitability of the Nifty 500 is also been published. Okay. So we found that it was 135 crores and PAT was 3.3 crores. Okay. Then in year 17, the nominal GDP has gone up from 135 to 152 and the PAT also gone up. Okay, fine. So there's a jump of 15% in PAT. This is actual data. So far I have not used any equation. Okay, so we found that the profitability of the PAT has also grown by 15%. Then in financial year 18, the nominal GDP had gone up by 170 crores and the PAT has also gone up by to 4.6. It has gone up by 21%. So now we can relate, how much is the nominal GDP is growing and how much the PAT is growing. The next, this thing. Then in financial year 19, the nominal GDP was 190 crores, whereas the PAT had gone up to 5.1. So that means there was an increase of 11% in the PAT. Okay. In financial year 20, when there was a COVID, okay, what happened? The nominal GDP had, rather the COVID impact came in 21. Okay. So the GDP had degrown to 197 crores from 203, and so here what happened in 20, the PAT had come down. Okay, fine. So PAT had come down from 510 to 430. Okay, so 16% decrease in profitability. Fine. And in financial year 21, it started recovering from 190 to 203, then it 197. Okay, the profitability grew, so it grew by 37%. So this was the time when the lockdown was over. So the PAT grew by 37%. Then in the year 2022, the nominal GDP has also grown and the PAT has grown to 9.2. So there's a sharp recovery, 56%. Okay. Then, 23, there was a 36%, increase, 30% in 24, and then 25, 21%. So this was the peak had passed through. The lockdown was over, so companies started selling more and more. But once there was a kind of a plateau, and the company started earning 21% increase in profit compared to 36 and 36. Then in the last this year, 26, which is the estimated, because so far March is running, last quarter is still to be announced. So the nominal GDP is going up, okay, but the PAT has declined. PAT has declined to 18.3 crore. So there is a 7% decrease in profitability of the companies. So that explains, the underperformance of our markets. Our Nifty share has not gone up. Nifty index has not reached to a high level. So, and we had reached to 30% peak, and thereafter we are declining. So the foreigners, and we had already touched very high valuation in the market, because the companies were generating huge profits. So people, generally when the people buy, the shares go up more than what they deserve. So we say that we are moving ahead of the fundamentals. So market had, crossed above the fundamentals level, and the share price were highly valued. We were, share valuing at around, P ratio close to about 25, 26. Okay. So we always say the market makes mistakes. Okay. Markets are never trading at a fair value. They can be either be over the fair value or under the fair value. So here that they were trading much higher. Okay. And then the reality check came in 2026 and 25 September onwards, the share market stopped. Okay. And there was a 7% drag because the labor, this thing. Okay. So the labor impact was 75 lakhs. Okay. Suppose we add this, the labor impact, which is written at the bottom, 0.75. If I add this, so then still, even if we take the labor code impact out of the picture, still we were minus 3%. Okay. So last year has not been so good for India. Of course, in the last quarter, Q3, we find things were turning. Okay, because the government had announced, GST reforms, repo rate cut, liquidity injection by the RBI, the 8th pay commission, which is going to, I think, which has been announced or going to be announced, and a lot of other measures which the government has taken, which is trying, now it is boosting up the profits. So Q3 reflected that. Okay, but in Q3, a lot of companies made a labor code provision, okay, which actually camouflaged the real results of the companies. Okay, so if I just, exclude this, so, if we take out the labor cost impact, so we are 7% down. Is that okay? Fine. Now, we can just see. So let's understand this chart. So here, the nominal GDP in financial year 17 has gone up by 12.3%. How we are calculated? If we just look at the formula here, so which has been done from here, these two numbers. Okay. So every year we can just calculate how the GDP is growing. Okay. So GDP is growing by 12%, nominal GDP, 12%, 11%, 6, 8%. There was a minus in, during the COVID. Then 19, 15. Now if you see 24, 25 and 26, the nominal GDP was not growing at all, which was a major concern, because it's a nominal GDP. If it grows, the companies become more profitable, because the inflation is part of the profits. Okay, so we are stuck up in a very low inflation in India, and the nominal GDP was a major culprit. We were saying that we are the fastest growing economy in India and the world, but the Nifty was not, the market was not behaving. Market was not going up. I mean, we are beating all other countries in the world in terms of, how much we are growing. But our Nifty was, and Sensex, rather than going up, they were either stable or gone up a little bit, because of the lot of money has been flowing. Why? What happens is that the FIIs, they are selling, but the DIIs, they are buying. Why the DIIs are buying? Because it's largely led by mutual funds. So most of, our younger people, they have made, SIPs. So a lot of money was flowing through SIPs into the mutual funds, and they were deploying in the market. So this was keeping the market steady. almost like 30 to 40,000 crores per month was going into the market. So it was not allowing the market to go down. But FI was highly, selling. So if there was no buying by the Indian, DIIs, our market would have fallen. But our market was kept in check by our inflow coming from the mutual funds led by, because a lot of people are now, investing in mutual funds. So they have opened the SIPs and they were pouring in money. And since our economy was doing well, so there was no reason for the Indians to believe that the market will go down. And they believed in the story, okay, and they were growing up and up. This is keeping the Nifty under check. Nifty is not falling. The foreigners are selling. Indians are buying. So, despite a very, there was this thing that, despite a very good fundamentals, despite the economy doing so well, why our markets are not participating in the rally? The Korean market has gone up 100%. The Hang Seng has gone up by 50%. The Kospi has gone up by so much. All the markets, even European markets have done well, and we were the laggards. Okay, why? Number one, we were trading at a very high valuation levels, and then the profitability was not growing. It was growing, but we were still at a very high value in terms of the valuations. Our valuation multiple is very high. If you compare with China and India, China P multiple is say sub 10, we were at 20. So people find China market to be more attractive because our market is almost double expensive than the China. Okay, and they since the China is going to do well, so they started putting money in China and elsewhere. So our markets were very high. Our nominal GDP is not growing, profitability is not growing, despite our economy doing well and our share market not participating in the rally. So there's a total disconnect with the actual reality with this thing, just because we were trading at a very high valuation ratios, number one. And after now, with a kind of a deep correction, we've reached to the stage where we are, all our large caps companies on Nifty 500, we have reached to a fair level. Okay. So now we expect the market to do well after the war, if the companies started making good profits, as it was reflected in Q3. So let's understand that. So nominal GDP is growing, but it has slowed down. Okay, because of very low inflation. Our fiscal deficit was brought under check by the government. Okay, which has resulted in, the inflation. Inflation was not going so much. The wholesale, was minus inflation. Okay, so if you look at the PAT change, okay, so PAT was changed by only 2.5%, and then 8%, then 20% negative. This is the COVID time. And so what is the PAT GDP change? Let's go to the formula. So, PAT is increasing every year. 15, 21, 11. So we are just looking at the change, not the number of 15, but 21, it was there in the next year, and earlier it was 15. So that means in the year 19, the PAT is going to grow. Okay, so that is what we are showing here. So PAT is so this is the PAT change. Okay, fine. So now if you look at here and assume these figures are right, they are all formula driven. Maybe I mentioned that 19 was going, but just check, it is coming from there. So there was a 12.3% nominal growth and 2.5% PAT increase from the previous year. So that means the PAT growth was 15% by this. So it is 1.12 multiplied by 1.02. So if we multiply that minus 1, so the formula is here, okay, which is written on the top. Okay, fine. So calculated PAT growth is 15%. Okay, whereas the actual PAT has grown by only 15%. So the economic formula has shown exact the same what has happened with the profit of the shown by the company. So this formula says that the nominal GDP has gone by 12.3%, whereas the PAT GDP change has been 2.5%. So if you multiply the 12.3 into 2.5 and add them in minus 1, looking at the formula, we'll find the calculated PAT, which is 15%, which actually resulted in, when we saw the profits of the company, they have also gone up by 15%, isn't it? So it is mathematically, it is proving the equation. Next year, the nominal GDP has gone up by 12%, whereas the PAT has grown by 8%. So that means the calculated PAT growth is 21%. So the actual PAT has also gone up by 21%, which is coming from here. So if we, okay, so this is the actual PAT. Okay, fine. So similarly, in year 19, there was, COVID time began. So the nominal GDP has gone up, but not to the extent what it was going earlier. So there was an increase of 11.2, and the PAT decreased. So we found the PAT increase was only 10%, whereas actual figures reported by the corporate world was 11%, almost the same. In financial year 20, the nominal GDP has grown by 6.8%, okay, whereas the PAT has gone down by 20.9%. The PAT changed, okay. So that means there was the actual PAT had degrown by 16%, and the mathematical equation also was pointing out there will be a decrease in PAT, okay. So in 21, when the lockdown was over, so the nominal GDP has gone down, but the profitability change has gone up, which has actually given a boost to the profit numbers for 22-23. Then in financial year 26, there was a PAT GDP change was minus 14, whereas a low the nominal GDP, so which resulted in a PAT degrowth of 6.5%. And actual also we have seen there is a 7% decrease in the profitability. Okay, so this is directly linked with the economy, and because the profit is part of the GDP. Okay, fine. So overall nominal GDP includes the profits of the companies. Okay, fine. So now this we checked for actual years. Okay. Now going forward, if you want to project, okay. So going forward, what is projected is that the nominal GDP will grow up by 10%. Okay, for financial year 27E, this is the estimated next year and the next to next year. So the good news is that the nominal GDP is going to grow at more than 10% in both the years. Okay, so the PAT is going to grow by 3.6% and 2.18%. So we have now the two numbers, the nominal GDP and the PAT growth in both the years. Okay, so now we can calculate. So that means there will be a 14% increase in the profitability of all the Indian companies in the next year. The year starting from April 2026 till 31st of March, the expected profit increase would be around 14%. Okay, whereas the profit growth for the next financial year thereafter will be 12.6%. Okay, so then some calculations has been done, and the combined effect will be 13%. So overall for the next 2 years, the PAT is going to grow at 13.4% CAGR combined for 2 years. Okay. So now what we have done, we have just calculated that. Okay, that the nominal GDP is going to grow at 10%. PAT is going to this thing. So this is going to be the actual PAT, which was 80, 20 crores, 23 crores. Okay. Then we can just see these numbers. Okay. So the revenue grows by 10%, EBITDA grows 12 to 13%, PAT will grow to 14 to 15%. Okay. So total revenue. So there will be that's why then 10% nominal GDP will lead to about 15% growth in PAT. Okay. So now what he has done is then and he has given the reasons why the PAT will go up by 15% in next year. No labor code. Okay. Then the CapEx cycle, all the leverage will come into play. Okay. Fine. So this sheet you can go through. I'll just share with you. Okay. Fine. So the net is that because the law, something might have changed. That needs to be. Suppose it's going to be over, say next 1 week or so. It's not going to have major impact on the Indian economy. Suppose the crude oil price has gone up and it is going to bring some more inflation. But the fundamentals of the Indian business, if it is a very prolonged war and it becomes three, then we will have a kind of a major problem. But we expect the Indian profits to grow close to about 15%. This is a very conservative estimate. There is a 15% to grow karega. So now if we assume the profits to grow at say 15% in the next 2 years. So I am asking a question to all of you. If the next 2 years we are expect to grow at 14 to 15%, okay, how our stock market will go up? How much percentage they will go up? Any idea? कैसे relate कर सकते हो इस सारी knowledge को? You know how much the stock market, how the stock market is going to behave with increase in PAT to be expected to be say 15% in the next 2 years. Will the stock market will go up by 15%? Say yes or no.
Can't say that the stock market will go by 15%.
So what is, if we have to theoretically discuss, okay, fine. If the markets are going to price in the fundamentals, assuming, because the market looks at the earning per share of the company, okay, if the EPS grows, okay, and the future is good, the share price will also grow up, okay, and the share price goes, then the Nifty EPS will also go up, Nifty 500 EPS will go up, okay. So if the profits of the company grow up by 15%, you expect the 15% increase in the profitability of Indian companies, how the share market is going to react?
So it will rise.
Huh?
It will rise.
It will rise by how many percentage? 15%?
I'm not sure.
So if you have to make an equation and say that, what will be your answer? What will answer? If everything is moving fundamentally, because it's not that if there is a war or there is some kind of event which is going to affect India, news flows. So how do we make an equation? How do we make an equation? You know, if somebody says that you are an analyst, after all, you're going to become analyst, isn't it? आपने analyst बनना है ना, you're going to work in a team of company or company. So what are the recipes? You know, what will be telling the investors how the companies, how the Nifty is going to behave?
All companies are not going up. Some companies will grow by 15.
I'm saying Nifty 500, Nifty 500, or Nifty 50, how they grow. It compares every company. So 50% is average. In Nifty 50 or Nifty 500 is an average. So average will go by 15%. What you're thinking is right. But since you are now saying that how much reliance is, I'm saying how the markets are going to grow.
We can multiply using the P
Huh?
We can get an average P ratio of the 500 companies and we can multiply the profit increase.
Anybody? Yeah. Definitely, he's somewhere in the right path. But I want an explanation. The perfect explanation is like this. Please listen carefully. So currently, if you look at, you know, there is a valuation and there is a profitability. Two things combined. If our valuation is high and the profitability goes up, in the last 2 years, our valuation was high, our profits were growing little bit. Okay, as we have seen, last year there is a minus 7% just because the labor code impact. If we exclude that, we were still 3% down. Okay, so but last year the PAT has improved. Okay, but that means our valuations have come down in the last 2 to 3 years. We were highly valued. Okay, but in the last 2 years the markets have not done so much. So valuations, number one, is there any chance of valuation going up? No, because currently we are trading at almost at a fair value. Okay, suppose the Nifty is trading at a P ratio of 21. Historically, in the last 15 years, the P ratio is 21. Fine. So, which means the valuation will not go up. We will remain at 21, but the profits will surge the market. अगर 15% इंक्रीज होती है एवरेज वे, our market will replicate that 15% increase in the profitability in the Nifty 500 or Nifty index. Fine. If you are trading at say 18 P multiple, okay, in that case we need to catch up the multiple also. We have to go to 21 plus the profits are surging up. So we have calculated the equation that there will be increase of 10 to 15% in the valuation and 15% increase in the profitability. So earning per share will also go by 15% and the valuation will also catch up to the historical levels. So we may be talking around 20 to 25% increase in Nifty. But in our case, our valuations are almost near to the fair valuations. So we will not get any advantage of the valuation picture. Our valuations are currently fair, assuming after a big drop in all the stocks. So today we are trading at almost a very attractive levels. And if everybody expects there is going to be increase of 15% increase in the profitability, so that means the Nifty 500 or 50 will also go up by 15%. Have you got it? So next year. So what is going to happen next year? If this we have 15% increase in on average the profitability, what will impact it will have on the market? Will it go by 15% or go a little less than 15% or go more than 15%? And what is the logic? Anyone who can explain this? Yeah.
So if we consider that the valuation is also increasing, in that scenario it would have increased by 20 to 25%. But since we are considering that the valuation remains constant because we are trading at nearly fair value, that's why it will go up by 15% if the
Absolutely. Now, if suppose the war goes on, the assuming there is no profitability. Okay, of course there will be some hit on profitability also because of the war. So, assuming there will be no dent to the, but our valuations go down, then we will do the valuation catch up also as well as the profitability catch up, isn't it? But if it is impact because of war impact, so we are going to go. So that's the situation. Is that clear? So this is how we look at the market. This clears the picture, okay? So the markets has to look at two things, the valuation as well as the future profitability. On that only, the markets are going to either go up or go down. So because of the profit is going to go up, say by 14 to 15%, the markets are going to go up, isn't it? They are going to go up definitely. But instead of 14 to 15%, they may go up by 10% because it may take some kind of a impact because the war is going to play a havoc on the profitability of the companies. So instead of 14%, go up by 10%. Fine. So, and from whatever level today we are, okay. So if it is say 23,500, so 10% increase in Nifty level will be how much? 2,300 more. So we'll that, but the analysts are expecting to grow at around 28 to 29,000 in 1 year's time down the line. Have you followed? Yes. Have you understood the link? Yes. So this is what is investment banking, that the people who tell you can apply this to companies as well. Just the last thing, time खत्म हो गया? 9. अच्छा अभी तो है. Okay. So one more thing, I'll just show you. Then we will. So then, I asked, let's calculate, link it to the individual profitability of the companies, okay? So this is done by the AI, Claude, okay? So I said, apply all this game what we are taught, like, the PAT to GDP growth, at this and reflect how, we can forecast the Reliance earnings for the next 2 years. Okay. So it gave me a model. Okay. So I'll share. Now look at Reliance. Now Reliance is a conglomerate, isn't it? So what are the businesses we have, Chenika? Reliance के क्या क्या business करती है? Just name the businesses what Reliance is doing. Reliance Industries. Just have a check. Huh?
It's in Reliance Jio.
Reliance Jio, very good.
Telecom, yeah.
Telecom.
And then it's in like oil.
Oil. So oil, there is only one business of oil or two businesses of oil?
So refinery they have in Jamshedpur.
Yeah. Which place in India? Refinery? Jamshedpur. वो तो टिस्को की है. Jamnagar.
Jamnagar, yes.
Jamnagar. So they have a
And
refinery.
they are into retail stores also.
Retail stores.
And they're into clothing also.
वो retail हो गया. So retail है और media.
Media, yeah.
They own CNBC. Okay.
CNBC
And I think some more channels.
and
Okay. So they are actually present in 5 or 6 energy business. They are entering into it. So oil, they have two types of businesses. What are those? Extraction and refining. Oil exploration, taking oil from the seabed, okay, and then converting them into oil, and then converting the oil to petrochemicals, petrol, diesel, LPG, then plastics, and a lot of products. So let me just show you here. So when I was coming to the Ghaziabad, so though I have done a lot of research, but let's understand what the Chat GPT told me. What is Reliance doing? Now, how the Reliance profitability, will grow if the crude oil price moves up. For example, crude is going up. So how much impact it will have on the profitability of the company? Will Reliance profits grow up or down? Okay, so let's understand that. But before that, we'll understand the business of Reliance. So first of all, it's doing two businesses in oil exploration and oil refining. Okay. Now, the oil business, it's a downstream and upstream and midstream. There are three kinds of businesses which are there embedded in Reliance business model. The upstream is taking the oil from the seabed up. Oil nikal raha hai. It's going up. Okay, upstream. Then the downstream is oil being sold to the final consumers. Whether they're selling in the export market or whether they're selling oil to petrol pumps or whatever means. Okay, and the midstream is the transportation of the oil. So they're making money there also. They're using their fleet, so they are earning some margins on that. So there are three types of the streams. Okay, upstream, downstream, and midstream. Now, the upstream. If the oil prices go up, they are producing oil. So the upstream business will be profitable or loss making? Profitable. So they are going to make profit there. But the second business is they're using the costly oil, converting them into petrochemicals. Oil, diesel, petrol. Okay. So there, the cost of the raw material will go up. But if the output price also go up, then only they will be making profits. If the demand of the output falls and the input goes up, the company is going to make a loss, but not going to make a profit. So it's a complicated game. Overall, it balances out in case of Reliance. Whatever profits they're going to make in the oil exploration will actually get offset against the losses they're going to make in the second part of the business, which is oil to chemicals. The demand of the petrol and other things go down. Okay, because there will be less, because of the war situation, prices are going up, so there will be a restriction of demand of oil. Okay, so which is going to impact this thing. So I'm just flipping it. Just read this. Okay, what's your name? Himanshu. Just read this.
The oil business of Reliance Industry is one of the largest and most important part of the company. It operates across the full oil value chain, from crude oil processing to selling fuel and petrochemicals. Let's break it down simply. Refining, core of Reliance oil business. Reliance owns world's largest refining complex in Jamnagar. It processes crude oil into usable fuels. What they produce: petrol, gasoline, diesel, jet fuel, aviation turbine fuel, LPG, and naphtha. These products are sold in India and exported globally. Key point: Reliance earns profit by buying crude oil and selling refined products at higher value.
Okay.
Petrochemical, very profitable segment. This is where Reliance converts oil into chemical and materials. Products included plastics, polyethylene, and
Just without that, plastics, polyester.
polyester, synthetic rubber, fibers, and packaging material. These are used in clothing, packaging, automobiles, consumer goods. Why important? Petrochemicals often give higher margins than fuel. Fuel retailing. Reliance sells petrol and diesel through fuel stations. Petrol pumps operate a joint venture with BP, Reliance BP Mobility. What they do: retail petrol and diesel, offer premium fuels, and expand fuel stations across India. Oil and gas exploration, upstream.
So that is an upstream, okay.
Reliance also explores and produces oil and gas. Major examples: KG D6 basin.
So this is the KG D6 basin they have in Jamnagar. So they are actually the oil extracting, okay.
Activities: drilling offshore wells, extracting natural gas, and supplying gas for power fertilizer industries. Integrated business model, big advantage. Reliance follows a fully integrated model: imports crude oil, refines it, converts part into petrochemicals, sells fuel and chemicals globally. This integration helps reduce costs, increase efficiency, and maximize profits. Why Reliance oil business is powerful? One of the largest refiners in the world, strong export business, high margins petrochemical operations, strategic gold partnerships like BP. Challenges: oil price volatility, environmental regulations, shift towards renewable energy. That is why Reliance is investing heavily in green energy alongside oil. In oil line, Reliance oil business: buy crude, refine it, convert to fuels and chemical, sell globally for profit.
Okay, Joe. So I'm just going to just skip this. I'll share this text also with you. So there's the retail business, oil and gas production. So this is the explanation of upstream, downstream. Okay. So upstream is getting oil from the earth. Okay. So like they're doing it from KG D6 basin. Okay. Downstream is processing and selling. Okay. So example like Jamnagar refinery. So easy to remember. Remember, always there's a confusion. Upstream upstream means up in the ground. So explores and upstream is basically taking the oil up from the ground. Downstream is down to the customers, refine and sell. So then I asked how it is going, the current price, petrol, crude price going up and down, how it is going to impact the profitability. Okay, I'm not going to share at the moment. I'm just going to share this little bit and then we end up. Then we have this. So this is so this is basically the cover, all the businesses which the Reliance has, and then the consolidated profit loss account. So this is made by the Claude. Okay, I have not gone deeply into it. So I'm just so these are assumptions. So it has made the crude price assumptions. Okay, for all the years, 3 years. Forecast it, and 2-3 years past. India's nominal GDP growth. Okay, and how it is going to be doing. So see, if it is 8.6, 15.9, then is now going up from 10 point. It is going to be 10% this year, and then 10.2 and 10.2 next year. Then USD INR rate. Then the Singapore gross refinery margins. That means it is producing oil to chemicals or oil to petrol. So what they are earning is called the margin. Okay. So so how much they are making? If you take the benchmark, which is the gross refining margins, so which has, $5, which is currently at about $3.8, and Reliance is making $5 more. So what's the reason? We'll check why Reliance is doing better. Okay, because it's an integrated player. Okay, maybe. Then the platforms, the geo platforms. Okay, the ARPU. The ARPU is going to be what is ARPU? ARPU pata? Have you heard what is ARPU? Average revenue per user. I worked for about 7-8 years in telecom. So we used to calculate, ARPU. We used to make projections for the next year. We used to make a budget. Okay. So we had postpaid customers as well as the prepaid customers. Okay. So our marketing team, they used to give us how many new subscribers we'll be adding. Okay. Suppose they say that we'll be adding 5 lakh new subscribers next year. Then we used to ask them how many will be prepaid, how many will be postpaid. In those days, they were about 80% postpaid and 20% prepaid. Now it is 99% prepaid and only 1% postpaid. Okay, fine. In those days, each customer in India was giving almost 1100 rupees of ARPU. That means, on an average, the billing, which became our income, was 1100 from each customer. So a postpaid customer was giving much more to us. A prepaid customer was giving 400 rupees. Average revenue per user. So you take the total revenue divided by the average customers or average subscribers, we'll get the ARPU. Okay. So now, at that time the price was very high. To start with, it was 16 rupees per call, and now it has become nothing. So the ARPUs have declined from postpaid to prepaid. Mix is now today at about 206. Currently it's 206. 206 rupees ARPU hai. When I started working, it was, combined ARPU was around 800 or 900. So we were earning 800 to 900 rupees from each customer. And today it has become 1/4 of that. Okay? Because the call rates have dropped. It's virtually free. You just pay a fixed amount and you're entitled for number of calls you can make. Okay? And the fee was that time 10 rupees per minute or 15 rupees per minute one time. Okay? And then went to 5, and virtually it is par with the domestic call rates. Okay? So the ARPU is basically, the number of units, the number of minutes the person talks multiplied by rate per minute. Of course, rate per minute concept has now gone out because, okay, the total subscribers, okay, then, we have the retail assumptions. So everything is given, okay. Then we have, he is given the profitability of Geo, retail, O2C, oil to chemicals, oil, exploration, then Geostar, new energy business which they are foraying into, and the consolidated. So this gives you the profitability of the company. Okay. So the PAT growth is going to be how much? Look at the last one. Okay. So the PAT is going to grow in this year by only 3%. Very bad year. Okay. Next year, this year is going to minus 31%. Okay. Then it is going to grow at 28 to 30%. Okay, I need to check why it is minus. It should not be. So he had made some mistake. I asked him to correct. So he made a correction. So I don't know whether this is a corrected one or not. Okay. So this way you can actually